This week, the Federal Reserve will have their next meeting, and everyone is betting that they will raise the borrowing rates by 75 basis points, and God forbid, 1 full point as some forecasters are saying. This Fed fight against inflation is destroying the housing market. That's right, I said destroying. The Fed's own report says that sales are falling across all 12 Federal Reserve districts. And the future is bleak, with the most latest inflation numbers still above 8%. As I have said, everything points to the Fed's raising rates again this week. The overall outlook for the economy or economic growth is weak in the next 12 months. Most, if not all, mortgage forecasters are saying that the strong inflation numbers will make it likely that the Federal Reserve will be more aggressive in their next meeting. New mortgage applications have continued to decline. It recently dropped by 29%. On the refinance side, that is even worse. It dropped 83%. Rates as of this video stands around 6%, which is double since last year. It doesn't take a genius to see that this is having a profound effect on the real estate market, and obviously not in a good way. Let me share with you what is happening in the 12 federal districts straight from the Fed Beige Book. The Beige Book is a Federal Reserve System publication about current economic conditions across the 12 federal districts. It characterizes regional economic conditions and prospects based on a variety of mostly qualitative information gathered directly from each of the district sources. In other words, this is the most latest snapshot of what is going on in those particular districts. In Boston, see what I did there? In Boston, this is what the report says. Higher interest rates cooled home buying demand, leading to fewer closed sales in the first district's residential real estate markets. Closed sales fell sharply over the year in all reporting markets, in a notable weakening from the previous report. The district noted that this decline in sales was due to rising mortgage rates and high prices due to inflation really tightened buyers' budgets. But even with this going on, home prices still increased over the year in all the markets reporting. But there's a little bit of good news. The year-over-year price increase has declined for single-family homes when compared to the previous report. Furthermore, the expectation is that home prices would continue to weaken in the fall. In the condo market, however, was slightly different. Price increases was about the same as the last reporting period. There is a feeling that the market is coming back to pre-pandemic levels. It's the same story in New York. The home sales market has softened over the summer while the rental market has continued to strengthen. In New York City, as well as across most of the district's home sales tapered off. The inventory of available homes, though still very low, edged higher. Home prices appear to have leveled off across most of the region, and the prevalence of bidding wars has receded noticeably. It was a slightly different scenario in the Philadelphia district. Home builders reported that contract signings for new homes continued to fall modestly, but they said sales traffic rebounded slightly in recent weeks, following the introduction of new incentives and lower price options. This most likely means that there's a lot of price adjustment that's going on or other financing options being offered to borrower to make it cheaper to buy. Basically, home buyer enticement programs. With regards to the existing home sales, the report said that it was down slightly, but prices were still increasing, but bidding wars or homes selling for more than asking price declined. In the Cleveland district, demand for residential construction and real estate remained well below levels experienced earlier this year. They are saying that this lower demand is due to higher construction costs and rising interest rates. The expectation in the coming months is continued slowdown. In the Richmond district, this summary, I think, is spot on what's happening and will continue to happen in the whole real estate market as we move forward. The report reads, residential real estate market activity declined moderately this period. Respondents indicated that sales volumes were slightly lower and there was a reduction in buyer traffic. Inventories of homes for sale and days on the market increased while home prices have softened. Demand remained strong, but it was noted that affordability was an issue as some buyers no longer qualified to purchase a house due to elevated home prices coupled with increasing mortgage rates. Existing new home construction continued, but new housing starts were down. Some input costs declined this period, like lumber. but the whole residential construction costs remain elevated. Like I said, I believe that what is going on in the Richmond district is what we will start to see in the broader market. The silver lining in this, if you will, is the fact that they mentioned demand is still strong, but affordability is an issue. And I've repeated this several times on this channel. We don't have an issue with demand. People want to buy houses. It's the affordability that's the issue. I won't go over the rest of the districts. I'll put a link in the description below if you want to find out what is going on in the various other districts. I'll just share this last one, the San Francisco district, obviously where I'm from. Residential real estate activity eased further over the reporting period. High mortgage rates and overall economic uncertainty cooled demand for existing and new single-family homes. Conversely, demand for multifamily housing units remained strong and rental rates grew in many regions. A Northern California banker reported a recent increase in financing requests for multifamily construction projects. Despite cooling demand, housing prices remained elevated and inventories strained by historical standards. Home builders' confidence declined further as material shortages continued to delay existing projects. Mortgage originators and refinancing activity dipped further as higher interest rates and limited inventories dampened housing activity. The other districts like Atlanta, Chicago, St. Louis, Minneapolis, Kansas, and Dallas, it's pretty much the same story. Decreasing number of transactions. Prices still remain resilient. Challenges with new construction, and basically lots of concern with affordability. In this week and the coming months, it's going to be more painful for home buyers as mortgage rates are expected to keep rising, likely to stay above 6%. If the Feds continue on this path of fighting high inflation, this will most likely speed up the housing market correction, which by all accounts is already here. The people most hurt by this are the cash poor buyers that are already struggling with increasing rents and can't afford homes at these prices. Two things we need to keep an eye out for to see where the housing market could go. One is inflation. We need to keep an eye out every time the inflation numbers comes out. The most recent reporting said that it was up 8.3% in August compared with a year ago. Now, you probably heard the White House say that inflation numbers have improved. There is some truth to that. Inflation fell from an 8.5% year-over-year increase in July and 9.1% in August. That is indeed an improvement, but we are still way off the Fed's where the Feds want the numbers. The target is 2.5%. As you can imagine, even with this drop in inflation numbers, the Feds will continue their march to increasing the borrowing rates, thereby pushing mortgage rates even higher. So, continued higher mortgage rates and with home prices still not declining, this is making it challenging for home buyers and why the overall number of transactions is going down. But when you look at the overall number of transactions going down, it's actually going down to pre-pandemic levels. And these numbers during that time was actually considered good. In fact, during that time, everyone was starting to wonder if we were headed for a correction already because the housing market was already considered high at that point. And we all know what happened. We just continued to go higher. So again, back in 2019, when we were at this level, everyone was saying how great the year was and we were due for a correction. And then we just skyrocketed from there. So the way I look at it, this kind of spike is just like what happened during the mortgage meltdown. But the difference is that this blip or spike that we had was good. The fundamentals behind this increase is solid. Strong borrowers, strong demand, lack of inventory, versus completely the opposite back in 2008 where you had weak borrowers plus bad financial products plus just a ton of inventory. So the number of transactions going down, I think this will be a return to normal and nothing to be concerned about. Interest rates at these levels, sad to say, is also a return to normal, although rates in the 4 to 5% range would be more ideal. For prices, I think both sides, buyer and seller, won't be happy. For buyers, it won't be a decline to levels that can be considered as a bargain. For sellers, it will look like they've missed the boat and left a bunch of money on the table, which to be fair, you did. But no one can time the market, so I guess that's a consolation. So the next few months up until next year, there will be this buyer psychology of things are bad, maybe I shouldn't buy yet because maybe, just maybe, prices will continue to decline much more. And actually crash the market. To which I say, if that happens, you'll probably be losing your job anyway, and you can't afford to buy a house at that time. And then on the seller side, which I still see a lot right now, is still this rosy projection of how things are. Thinking that there is just this one buyer out there that will pay their inflated price just to find out that it will never happen. Basically, it will be a lot of what ifs on both sides. But here's the silver lining before I go. If we do go into a prolonged recession, guess what happens? Interest rates go down. Something to look forward to, I guess. Hey, thanks for watching, guys. Please don't forget to like and share and subscribe. If you're thinking of buying or selling here in the Bay Area, give us a call, a text, or an email. Would love to help you out.